So the market can kind of hang in here. I guess it's completely fully valued, Anthony. We're trading at the projected earnings growth of 14%. We're trading at 22 times that projected growth rate. So I kind of see the market in a trading range. The salient danger is, well, we still have a massive equity bubble and a bond bubble and a real estate bubble. The pin for that would be the 30-year treasury. If the long-term rates begin to spike out of control, then the whole thing comes collapsing down. I have a model that measures and maps the whole thing. And that's going to keep me hopefully on the right side of this trade. Right now, as I said, we were defensive. We continue to be defensive, but we're not net short yet. So we think we're in a trading range, and we're going to trade that range as best we can until we get some catalyst to burst these bubbles, and that will be the credit markets.
Hey everyone, welcome to another episode of the WTFinance podcast. I have the pleasure of welcoming back Michael Pento today. So Michael is the president and founder of Pento Portfolio Strategy. So Michael, thanks so much for coming back on the podcast today.
Good to see you, Anthony.
Yeah, good to see you too. Looking forward to speaking to you again. I think we just sort of spoke late last year, and God, it feels like a lot has happened since then, or maybe even early in the year. But even then, it's just, it seems like we've lived decades in months. Which is pretty crazy to think. But yeah, I'd be really interested in hearing just your current overlook, starting very broad. What are you currently seeing in the economy? What are you currently seeing in markets? And you can take it wherever you like.
Yeah, well, right now I'm in a defensive position. I've been in a defensive position since the beginning of the year. Not because I thought the market was going to collapse. I mean, the market collapsed because of this tariff and trade war that Trump started, and it could be easily ended with a stroke of a pen, and that's exactly what he did. So he capitulated when the bond market said, no, this is not going to happen. So, now we're kind of like in limbo. We're at 10% across the board, 30% with China. And I guess, at the last salvo was from Trump is, well, we're going to wait a few weeks, 2 or 3 weeks, and we're just going to assign a tariff rate to the rest of the world, whatever it is. The baseline is 10. So tariffs are going up. They're going to be at 10%. That's 6 times higher than they were last year. So taxes have gone up by sixfold on the tariff front. So that's a depression to growth. You also have the immigration, which has been cut down dramatically, which is a hit to labor force growth. And we have a kind of on the margin, we had Doge do a little bit of here and a little cutting there. But I guess more importantly, those are all depressants to growth. But now what I'm most concerned about is the bond market. And the long end of the bond market is now sent mortgage rates to over, it's 7.08% now. So you've made an unaffordable housing market even more unaffordable, but the cost of spiking interest rates. So the market can kind of hang in here. I guess it's completely fully valued, Anthony. We're trading at the projected earnings growth of 14%. We're trading at 22 times that projected growth rate. So I kind of see the market in a trading range. The salient danger is, well, we still have a massive equity bubble and a bond bubble and a real estate bubble. The pin for that would be the 30-year treasury. If the long-term rates begin to spike out of control, then the whole thing comes collapsing down. And I have a model that measures and maps the whole thing. And that's going to keep me hopefully on the right side of this trade. Right now, as I said, we were defensive. We continue to be defensive, but we're not net short yet. So we think we're in a trading range, and we're going to trade that range as best we can until we get some catalyst to burst these bubbles, and that will be the credit markets.
Yeah, definitely a lot to unpack there. So if you look at tariffs, do you think this whole thing has been Trump trying, 4D chess, him trying to put up at 10% tariffs on everyone, and basically, as you said, he went up to over 100 with China, and now it's back down to 30. Is this just a way for him to implement tariffs without the market blowing up, by blowing it up with higher tariffs and then putting them down?
Well, Anthony, the way I look at it is Trump had a very noble effort. He wanted to boost the middle class that's been eviscerated. He wanted to rebuild the manufacturing, create a manufacturing renaissance in the United States. And he wanted to balance the trade deficit. These are all wonderful goals. And I think his goal was to put a significant enough tariff level that would offset the difference in workers' pay. Like if you look at a Vietnam worker makes like $3,000 a year, and a U.S. manufacturing worker makes $36,000 a year. So you just, the math doesn't work unless you have massive tariffs. That's what he put on. That's what he thought would work. And that was the Rose Garden celebration, was Liberation Day in America. He thought that would probably lead to, a rebalancing of all those conditions I just mentioned. The only thing got in the way was the bond market. The stock market and the bond market said, no, this could work in the long run, but you're going to have a depression on the way there. And politicians don't like depressions. That's just why they always resort to borrowing, spending, and printing, because it's much easier to do that. It's much easier to hide runaway inflation than it is to hide bread lines in a depression. They'll just tell you you're wrong. Well, it's you can't afford a house, but it's not my fault. It's just, the supply of homes isn't there, or something like that. Or you can't afford education, you can't afford insurance, you can't pay your taxes, can't afford a new car, but it's not my fault. And the inflation that you're seeing is a figment of your imagination. That's easier than to tell people you're starving to death on a bread line and the economy is collapsing, but it's not our fault.
Yeah, and I guess it's only so long they can do that until it really starts to pinch. And I guess that's what sort of where we are, seems to be where we are currently.
Yeah, that's what you see happening in DC. I mean, we have a $37 trillion national debt. So what's going on now is you're having the extension of the TCJA. The Tax Cut and Jobs Act. That's $4 trillion in revenue that they said that's going to be there, but now it's not going to be there. So the projection is for the debt to rise to $58 trillion in the next 10 years. But if you look at the realistic numbers with all these, the extension of TCJA and then no taxes on tips and no taxes on overtime, no tax on Social Security, and you're writing off $10,000 of interest payments on your car loan, if all that gets passed, and that's where it's heading, you're looking at $67 trillion in the national debt by 2035. It took 250 years of this nation's history to accumulate $37 trillion in debt. And we're going to add 30 trillion to that pile in 10 years. Let that sink in for a second. Now, will the bond market handle that? With quiescence? I doubt it. The Fed is still in some muted version of quantitative tightening, so they're not really expanding their balance sheet. They're still, in theory, selling off some of their balance sheet, but it's not growing. So the base money supply, high-powered money, is not moving anywhere. Foreigners don't really want to buy our debt any longer and store their currency reserves because in U.S. Treasuries, because look, there's confiscations, there's sanctions, there's the tariff wars, the trade wars, there's our problem with inflation. We have now a problem with insolvency. So foreigners are not really willing to purchase all these bonds. We don't have the savings to do it. We don't have the domestic savings to do it. So who is going to buy all of these trillions upon trillions upon trillions of dollars in debt? Well, the answer is that eventually it's going to be the Federal Reserve. And that's going to just exacerbate greatly this problem we have in inflation. So you're looking at stagflation like we've never seen before in this country in the out years. That's where we're headed, unfortunately.
Yeah, it does seem to be the trajectory. And I guess everyone was thinking, well, not many people believed it would actually happen. Musk would come in, help to reduce the deficit. But obviously now it seems like they've just gone back to where they were before and back to printing as much.
See, America's problems are so enormous, or the bubbles are so tremendous, that when you actually try to do something about them, Anthony, you get a depression. You don't even get you actually you go from trend growth to a depression very quickly. You actually try to cut spending, If you try to pop the real estate bubble, if you try to pop the equity bubble, you get a depression. That's how deformed these things have become. So you skip a recession, you go right to depression, and then they say, "Oh my God, what are we doing?" Let's just keep borrowing, spending, and printing. And you're going to keep doing that. You'll keep some semblance of solvency in the economy and in markets until the long end of the bond market goes haywire. I wrote a book about this in 2013. It's eventually where we're headed, and you're living it right now.
Yeah, because as you said, there's been a lot of volatility in the long end of sort of the bond market, especially today and even the last few weeks, tariffs, uncertainty with increased deficits. Do you see this continuing to get worse, or it's hard to? I guess it's hard to time this because we always think that there's going to be an issue, but then somehow it always goes back to normal.
I think it's going to get a lot worse. The timing is the question is the timing. So that's why I have the inflation, deflation, and economic cycle model that I created. Look at things like credit spreads and financial conditions and the copper gold ratio and the level of real Fed funds rate. I mean, it's a 20-point model, and it lets me know lets me know the arcane components of the market, because all the market trades on is on insider information. I don't have that. So I have to look at the legal insider information. When they start dumping junk bonds and buying treasuries, they being the people actually know what's happening. And then the last person to know are the people who watch CNBS. The last people to know are the public, who are just blindly funding their 401k plans. Those are the last people to know. You want to be way ahead of that. And the model allows me to get ahead of that. So I can sell when the market's ready to collapse in a significant manner. And then I'll be a buyer when the last people call up their 401k plan administrator and say, "Hey, move me to cash." That's when you become a buyer. That's the plan. I mean, that's the truth, Anthony, when you think about it. To being a perma bull or a perma bear, or, suppose you have somebody who's being managed by one of these, set it and forget it portfolio managers who'll say, let's do, I met at your house. I had some cookies, and you want to save for retirement. And you want 60% of your portfolio in long-term bonds or 60% in cash and 40% bonds, depending on your age, or your lifestyle choices, whatever that means. Listen, the calculation is, hey, you want to make money as safely and as best you can. That's the predicate here at Pento Portfolio Strategies. You're qualified for the portfolio. You want to make money. You want to participate in bull markets. You want to protect and profit potentially from bear markets. That's the way I look at investments. But if you're in someone who's in a portfolio manager's portfolio that says, I want to own long-term bonds and the riskiest portion of the equity sleeve, then your retirement is going to be canceled. You have to be a lot smarter about your choices of investing today than you were just a few decades ago, because we're living in an unrealistic, manipulated world dominated by not markets anymore. There's no longer a free market. So even, look at Japan. There's no market for their treasury complex. Japan had negative nominal and not real, negative nominal rates. Of course, in real terms, they were very much negative, but in nominal terms, negative rates from 2016 to 2021. And now their interest rates are spiking to 1.5%. That's another reason why foreign borrowers are not going to be there, blindly buying our treasury market. You add that on top of the trade war. There's less currency reserves to park because there's less of a trade surplus to recycle into dollars. So all signs point to me that there's problems ahead for the credit markets, and that is what you have to be myopically focused on. I have a model to do that, and it's going to hopefully, God willing, get me and my clients out of harm's way when this thing collapses. But until it does, we're just going to, I think we're in a trading range here. We'll be buying the dips and selling the rips, as they say, until this thing finally reconciles, and it will be devastating when it happens. Even more than it. By the way, I want to parenthetically add. We have we've had massive corrections in the stock market. It's not like I'm some Cassandra saying, "Oh, you keep saying this, you keep saying." No, where were you in 2000? Where were you in 2008? Where were you in 2018? Where were you in 2020? Where were you in 2022? You do have these massive sell-offs that should be actively managed around, as long as you can also participate in bull markets. That's the key. Don't be a perma anything, and certainly do not stay with a passively managed portfolio. That is the disaster.
Yeah, it's a great point. As you said, it's always questioning your beliefs and what you're seeing, and whether they're correct. I think is a key thing to do. So then I'm guessing you say you're sort of trading during this period. I'm guessing this recent tariff volatility has sort of been a perfect opportunity to, buy in when the market's worried about long-term ramifications. And then, as you said, we're sort of going to the higher, so potentially sell from there. So that's sort of what you do in these really volatile situations where maybe it doesn't even show in the data because it's happening so quick.
Yeah, I mean, you try to look at what's happening. So I think of things about the tariffs. So what could change is, let's just say in the next couple of weeks, Trump comes out and he says, "Okay, here's a list of our 18 largest trading partners, and they're no longer 10%. They're going to some range between 20 and 30. Whatever, maybe something that matches what was purported to be put on them on Liberation Day." Well, that's gonna tank the stock market. And in my opinion, you have to react to that. Now, the base case scenario is he learned his lesson and he's not going to do that. He'll be somewhere around 10% with every country ex China. China might be somewhere around, stay around 20, 30%. It'll be a little bit higher in China. That's what Wall Street now believes. But that could change, and I would have to change my belief in my allocation if that changes. The other thing is this big beautiful bill that's going through Congress right now. It just passed the House, but now it's going to go to the Senate. The Senate is going to totally rip it apart and come up with their own bill, and then it's going to have to go back to the House. Well, I think there's going to be some very significant changes made. Can they get this thing voted on? Well, the base case scenario is they find a way to get this thing done. And that's when you get $37 trillion in new debt over the next 10 years. By the way, when I say $37 trillion of debt, that assumes there's no recession. The CBO assumes there's no recession in the next decade. Well, the U.S. averages a recession every 6.5 years since World War II. So is it reasonable to assume that we are going to have, so we have $37 trillion in debt now, and the projection, my belief is we're going to add $30 trillion in the next decade. That assumes, on top of the $37 trillion we already have, so we're talking about $67 trillion in total, just get the numbers straight. That assumes there's no recession. If you get a recession, the annual deficit, which is right now $2 trillion, $1 trillion in interest payments, we're going to be having annual deficits that are supposed to rise to $2.7 trillion if there's no recession. But if we have a recession, it could easily be $6 trillion of annual red ink. It's just a matter of, this is what happens in a recession. People get laid off. The income to the government attenuates greatly. So you have less revenue, but expenditures skyrocket because of the automatic stabilizers built in, like unemployment insurance. So you could easily rise to $6 trillion, and then you have a huge problem. You're going to have a situation where the Fed has to come in and be the buyer, because in normal recessions, the long end of the bond market, those yields tend to fall. But what if they rise instead, or only temporarily drop on the margin, and then react very negatively to the $6 trillion in deficits that we're going to have on top of the debt that already in existence? So again, I am myopically focused on the bond market to get this trade correct.
Yeah, and it seems Scott Bessent, he's more talking about you have to grow your way out of the debt issue. So, but it sounds like as you said, it's impossible to cut the deficit because then you get a depression. It's, obviously they've increased it, so maybe they couldn't have done that. You reduce the tax cuts. So yeah, it just seems like there's not much that they can actually do to change it.
Anthony, when, and I'm a libertarian, so I'm all for tax cuts. I'm for tax cuts and spending cuts. But when have we ever been able to grow our way out of the deficit? When has that ever happened? We had a slight.
Never. You inflate yourself out of the deficit.
And even then, you don't really inflate yourself out of a deficit because you have an adjustable rate mortgage on your debt. So if you finance all of your debt in the very short end of the yield curve, like the United States does, then you have to roll over that debt more often. Well, if I'm inflating my way out of the debt and inflation spikes, I'm rolling over that debt at much, much higher interest rates. And your interest on the debt prohibits you from ever paying down your debt. I mean, it's already over $1 trillion. It's the second largest budget item that we have, even ahead of defense. So no, I don't think you can inflate your way out of the debt. What you can do is cut spending to get yourself out of debt, or reset the currency, or just default on the debt explicitly. That's one way to do it. I mean, our debt is 720% of our annual revenue. And we're not adding, you say, okay, wait. So the debt is 720% of our annual revenue. And you say, well, that's a pretty bad situation, but maybe we're at least paying down that debt slowly. Well, no, you're adding to that debt pile. You're adding 40% of your revenue, 40% of your revenue to that debt pile every year. So you don't have the revenue to make things better. You're making things worse every single year. That's why we're in big trouble with the bond market.
Yeah, and it sounds like, you'll have to, as you said, the Fed will have to buy, and it'll have to be yield control. It'll have to be, financial repression. Maybe they'll force banks, they'll force pension funds, they'll force basically anyone they can to buy the bonds. Yeah. So
Anthony, that's true. But are they going to force those institutions to buy municipal debt too? How about corporate debt? I mean, so yeah, we both agree that the Fed is going to try to inflate their way out of it, because we're going to inflate our way out of the debt. But when inflation has already been a huge problem, inflation has already wiped out the bottom 3 quintiles, and it's severely injured the fourth quintile. It's only the top 20% of consumers that are really doing well, keeping this economy going. They don't have a problem at all yet. But you're now gonna, on top of what you've done to the middle class of this country, you're going to now embark on a whole new wave of rampant inflation, back to double digits. Is that going to be the panacea for the economy? I highly doubt that's the case. So that's why I come back to active management is going to be crucial. There are going to be times of depression and times of recession and times of stagflation. And, you think about the way I think about things, during times of stagflation, you want to short the bond market. You don't want to be piled into the long end. You don't want to be piled into duration in stagflation. But a lot of people will do that because they just have this set it and forget it portfolio strategy. In a recession or even a depression, how much of the Mag 7 do you want to own? None. You want to be short those. You want to be loaded up on treasuries. And we are going to swing violently between stagflation and depression over the next decade. And you better have your finger on the trigger and your pulse on the economy and a model that works. I do.
Yeah. And as you say, compared to the 70s, I think, as you say, corporations weren't over-levered. Individual people weren't over-levered. Basically, there's leverage everywhere.
The government wasn't over-levered.
Yeah.
Now you're talking about the national debt to GDP was like what, like 35, 40%?
Mm.
Now it's 130%.
Yeah, it's not. as you say, there's ways around it, but yeah, it's just being aware of what's potentially on the horizon. And then I think I've heard that you've mentioned in a different interview, and I'm not sure if that's still the case, that you sort of rotated into commodities and agriculture. Is that still the case, or have you sort of changed since then?
My portfolio does hold commodities because they are going to try to inflate their way out of it. We own a tremendous amount of short-term treasuries, just spinning off over 4% into the portfolio per annum. We have a small short. We own gold, and we have about a 19% position in equities. So again, we're not bearish right now. We're not net short, but we have plenty of buffers in the portfolio, and we're ready to move either way. I believe very strongly that eventually we're headed for stagflation, but getting the timing right is perfect. And I think the stagflation is going to be a direct result of a recession that could easily morph into a depression. And so the game plan is to play this trading range as best you can and get ready for the next catalyst, which again is going to be chaos in the bond market. I see that happening. I see it happening this year.
And what would turn you bullish? Is there anything? What would it just have to be yields coming down?
Well, I'm bullish on what? Bullish on what?
Equity. So I guess high risk, high.
Well, first of all, equities. Great question. So first of all, equities would have to not trade at earnings growth of 14% and a 22 multiple on those equities when you have nominal GDP, which is going to be around 4%, and margin compression in stocks. I don't see how you can get 14% earnings growth when GDP growth is going to be well below trend, and due to tariffs, you're going to have margin. I mean, here's an example. So first, Donald Trump says that, Americans don't pay tariffs. The exporting countries do. Well, that's partially true. The exporting country can eat the tariffs themselves. They can wreck their currency, strengthen our currency, which is the opposite of what's happening, by the way. The importing company can eat the tariffs, or they can pass them along to the consumer. So there's basically those three components. The country's currency can go down, the exporter, and you have the importer. There's four components, and then you have the consumer. There's four people. There's four entities that could help assuage the level of tariffs. But even Walmart said, "Hey, listen, we 10% is think about it. Everything in the store is going up because if you turn an item over in the store, very few of them say made in the USA. They don't say made in China or Vietnam or Bangladesh. So prices are going to go up, should go up 10%, 30%, but they're not because, as I said, there's middlemen in there that can eat some of the tariffs. But Walmart said they're going to have to pass along some 2, 3, 4%. I don't know the exact number. Neither do they yet. They're going to have to eat some of those tariffs. Some of those tariffs will be eaten by Walmart, but some of them will be eaten by the consumer. So the fact that the consumer is going to have an increase in prices is one issue, but the other issue is that Walmart's margins are going to be reduced. So how do you get earnings growth of 14% in a world of below trend GDP growth and shrinking profit margins? Wall Street hasn't realized this yet. And that's why the upside is very, very limited, especially if tariffs go up. So stay nimble, don't fall asleep. Maximum flexibility is the best goal, is the best tactic.
Yeah, definitely. A good point is that earnings have gone up in a ridiculous amount in the past 5 years, let alone the past 10 years. Unsustainable levels.
Because nominal GDP was spiking. We had if inflation goes up, so you have the cost of goods sold, and then you have the revenue. So if your revenue is always higher than your cost of goods sold, but if they're all going up 20%, right? Your earnings soar. It's simple math, right? So when inflation isn't soaring, and inflation isn't soaring anymore, the profit margins aren't going to soar as quickly. They could in the future, but not right now. So there's no way you're going to get 14%. There's not a chance you're going to get 14% earnings growth. And why would you pay 22 multiple on that? I have no idea.
Yeah, so many great points. So Michael, thanks so much for your time today. We sort of touched on a lot of things, and yeah, let's see where the market goes. But my last question is, what is one message you'd like people to take away from our conversation?
Well, it would be, if you are in a static portfolio, a static 60-40 portfolio, get out and find somebody who can actively manage these trenchant and dramatic moves from stagflation to recession. They've happened before in the past. They're going to continue to happen. They're going to be more intense and happen with, greater frequency and greater intensity. So do yourself a favor and fix that problem.
Yeah, it's a great message. So thank you so much. If anyone wanted to find out more about your work, where would the best place for that be?
So the website is pentoport, PORT.com, Pentoport. I have a midweek reality check. It's $50 a year. You can get my 36,000 foot observation of what's going on in the market, the salient economic data of the week, and my interpretation thereof. And if you are qualified, if you have $100,000 and you are a U.S. citizen, I will personally manage your money in the inflation, deflation, and economic cycle model, where much of my money is there as well.
Great. I'll put that description below, but thanks for coming on. You're always a very popular guest, and I appreciate talking to you.
My pleasure, Anthony. Take care.
Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right. Thanks again.